Hi, everybody. My name is Dustin Anderson from Company B. Later on in this presentation, you will be meeting our other teammates, Tyra Givings and Carson Lamont, and this is our presentation of the business strategy game. Hope you enjoy. Hi, everybody. We wanted to start our presentation off going over an overview of our final numbers after year 20 of the key metrics within the business strategy game. And those were earnings per share at $1.53, our return on equity of 10.1%, our stock price of $7.70, our credit rating of A+, and our image rating of 54. We wanted to start our presentation. Our strategic plan here in years 10 through 14 were to attempt to penetrate all four available markets available to sell to with our North American and Asian manufacturing facilities. And our primary focus here was the internet and wholesale segments. And we did try to avoid some costs. However, we put a lot of money into marketing in order to help us better penetrate all four markets available to sell to. And the results of this is that each year we were able to sell sufficient amount of shoes to each geographic market while keeping our prices below the industry average. Our strategic
Hi, my name is Tyra Givings, member of Company B. Our 15 to 17 strategic plan, our year 15 to 17 plan, was to slowly start decreasing the investments that we were putting into marketing. We recognized that our marketing investment had been too high in previous years with little results and yielding low amounts of progress toward our ultimate goals. And so we started decreasing that investment to get closer to what we could assume the industry average spending on marketing was. And we also started increasing our global footprint with new facilities. So decreasing our marketing investment and increasing investment in global footprint, but also improving our quality and SQ rating. Our quality and SQ rating improvements yielded great results as our SQ rating skyrocketed from year 10 to 20, as you can see in our diagram here in the line graph. These strategic changes that we made in years 15 to 17 not only yielded results to our SQ rating, but we significantly reduced our market expenses per pair sold in our wholesale segment and our internet segment. And as a company in general, we did take a narrow approach into market penetration. And so most of our success and revenue came specifically from these segments, if not all of it. So our wholesale segment decreased from $13.63 to $12.87, and our internet segment also decreased from $39.73 or 78 to $34.46. We continued to penetrate all four regions, geographic markets, in particular with those two new facilities, which yielded results for us, helping our SQ rating, and then ultimately helping us maintain our position as the lowest cost per pair sold in all of our wholesale and internet segments. Much like our previous years in 15 to 17, 18 through 20, we continued to decrease our marketing investment. We wanted to slowly bring down our marketing costs and expenses, not creating a large deficit to where maybe perhaps customers might notice a lack of presence, but slowly pull back. And this allowed resources to be focused on areas that data indicated needed improvement. For example, celebrity endorsements. We were able to offset the potential risk of losing publicity and losing our position and being seen through celebrity endorsements. We secured 2 in these years, and that made a large difference. We also increased our SQ rating in years 18 through 20, again, going with our slow, conservative, progress is still progress approach. We continued to increase our quality, reallocating resources revoked from marketing to maintaining fiscal conservative approaches to increasing quality.
Our results from our strategic plans for years 18 through 20 were quite rewarding, and we made a big push to try to reduce our marketing expenses. And we didn't want to reduce our wholesale marketing expenses too much, and our wholesale marketing expenses per pair sold actually raised from $12.87 to $12.98, so just very slightly. But in the internet segment, they reduced from $34.46 to $21.14. So that saved a lot on our marketing expenses, and we were still able to sell a good number of shoes in the internet segment. And our SQ rating continued to significantly rise from being just over 6.0 at the end of year 17 to by the end of year 20, we had it almost a 7, which helped a lot with our overall numbers. And for years 18 and 19, we also were able to finally win 2 celebrity endorsements, which helped us significantly in our numbers. As you can see in the graph below, that our earnings per share and return on equity more than doubled during these last 3 years. Our results from our strategic plan. During the business strategy game simulation, we felt that a relevant strategic model that we used throughout the whole entire game was the Ansoff matrix. And we did not necessarily try to create new products, we tried to make our products better. But we certainly tried to penetrate existing markets as well as penetrate new markets, as such as the private sector within each geographic region, as that had not been penetrated. And we also tried to penetrate the existing markets and better distribute and sell our products in each of those. During the business strategy.
Hi, Dr. Nazakati. My name is Carson, and I'm going to be presenting over the next couple of slides. So the first challenge that we faced was falling behind in key performance metrics. So early on in the simulation, we did pretty well the first couple of years, and then around year 3 and 4, we dipped off pretty significantly. This affected our ROE, our EPS, our stock price, and our market share. We were right near the bottom, unfortunately, in game-to-day performance for multiple quarters. So we found that the root cause of this is our misaligned strategy execution. So our actions didn't fully support our chosen strategy. Especially, we found this especially true in pricing, marketing, and geographic focus. We underinvested in brand building, and we had a lack of participation in the private label sector. What we learned from this is that our strategy has to be executed consistently across the board, especially in decision areas like pricing, marketing, operations, finance. Early missteps, unfortunately, create a compounding effect, so it affected us throughout the length of the game. And we found that competitive benchmarking is essential to remain aligned within the industry standards. The second challenge we faced is losing bids for celebrity endorsements. So we had a pretty big challenge securing those endorsements each year. Despite multiple bids, we did bid on the majority of years. I would say our company consistently failed to secure the endorsements. So as we know, this was a key driver of image rating and marketing appeal. And so the competitors that we had with other companies with endorsements, they gained significantly more brand visibility and customer traction than we did, which in turn hurt our performance metrics. We realized after analysis that we underbid when compared to competitors due to the limited funds that we had from our mistakes early on in the years and aggressive cost control in early rounds. And we also had late recognition of the strategic value of the celebrity endorsements. So we underestimated how crucial these endorsements were. And so we didn't prioritize it in the beginning since we were down a significant amount of money and we were just trying to get back to the at least break even as quickly as possible. So we didn't really have the funds to put there. So what we learned is that celebrity endorsements are a large strategic investment and they're not a luxury, and it can early investment within the endorsements can yield compounding brand benefits as we've seen through our competitors, and that success requires a proactive, not reactive bidding strategy. So if we would have started bidding early on in the years before we had kind of tanked our numbers, we would have had a better outcome, therefore increasing our performance metrics, therefore allowing us to do better throughout the course of the simulation. We addressed our key challenges a couple different ways. The first thing that we did was really hone in on reducing our poor performance metrics. We did this by reassessing our original strategy and adjusting our spending within training, TQM, and advertising. We also became more financially disciplined by controlling unnecessary costs. So this really helped us in the long run. We responded to endorsement bid failures that we had had previous years by learning to bid more proactively. And this eventually landed us an endorsement in our final year, which helped significantly within our marketing strategies. By making all of these changes, we were able to significantly improve our standing within the final years of the simulation and actually end up making a profit, whereas previous years we were significantly negative.
For achievement number one, we wanted to talk about our dramatic improvements in performance metrics, particularly later within the strategy game. And we improved our key metrics significantly, such as our earnings per share, return on equity, stock price, and image rating, as well as our market share stabilization in core regions. And some key actions that we took was refined our strategy to better align our pricing and quality and marketing with each other. We greatly reduced our marketing, which certainly helped our numbers a lot. And then we optimized production and inventory to reduce cost and eliminate waste. We started the last couple of years when our numbers really improved. We stopped shipping pairs of shoes across oceans or to other countries, and we only sold shoes within the country that they were manufactured in. And then as a result, we didn't fully meet our investor expectations, but we were happy with our strong upward momentum that we achieved in the last couple of years of the simulation.
Our second achievement, and what I would argue would be possibly our greatest achievement, would be our strategic resilience and our ability to adapt each week. We really struggled throughout the length of the simulation. Like I said earlier, we started off pretty strong, and then somewhere along the line, we really dipped off, and we had to really fight to get back to a profit at the end of the simulation. So each week, instead of getting down on ourselves and continuing to do the same thing that caused us to kind of get in the rut that we were in, we met weekly, we communicated constantly over messages, with emails. We reached out to you, Dr. Nezzacati, for help and guidance on kind of how to get us back to a good standing. And I really think that our resilience and our ability to keep communicating even when things weren't going great is one of our greatest assets and one of our biggest achievements. Without that and without our willingness to keep going, and our flexibility and our ability to make time to keep meeting sometimes multiple times a week to try to figure out what we can do to better improve our strategy, to improve our standing within the game, I think we should be really proud of. And I think it made a significant difference at the end. As we can see, while our numbers didn't end up super great like the other companies, we did make a significant comeback. And I think that is worth recognizing.
Okay, you have just heard an overview of years 10 all the way to 20 in Company B and our performance. Our final achievement that I would like to highlight is our conservative financial management and maintained profitability, which we continued from year 10 all the way to 20. And that allowed us to become the company that has made the most linear and the most significant improvements from year 18 to year 20. We were able to successfully maintain profitability across all regions despite challenges or changes in the market. We were able to do so by keeping our liabilities to a minimum each year, staying at a stable production cost in our internet and wholesale segments, and then also with our strategic moderate pricing strategy. Not the cheapest shoe, not the most expensive. We were able to maintain a comfortable space in the market at a competitive rate. How did we demonstrate these achievements, and what do we attribute these achievements to? Our weekly reviews and meetings, which assess prior results and adjusted financial decisions according to those results and the data that was given. We also attribute them to team collaboration. We communicated consistently, clearly, and were able to strategize what changes need to be made. Even so, reaching out to the best in the industry, Professor Nezzacati, who was able to give us specific, clear goals to reach and to set so that we would be able to achieve our profitability and also stay in competition. And lastly, we attribute these to our tactical flexibility week to week. We were not shy about making changes, though we did have a conservative approach and we were slow to make large changes. We as a team knew that what changes needed to be made, and we collected the data weekly to ensure that those changes were yielding the results that we desired. And so we were the team that created the largest linear impact.
Please see attached for our references, and thank you very much for listening. Have a good one, everyone.